Good evening, one and all, especially the speakers for the day, GKR sir, and all the attendees. A warm welcome to you all. And today is another important day for this webinar series in Valuation under Income Tax Act. It is one of the most happening subjects, I can say, and many would not have spent much time on practicing this or not thought of practicing in this area. So this is another what's called a contribution or effort by SIRC to bring this valuation subject closer to the hearts and minds of the members here. So for this special program, I very warmly welcome Dr. GKR sir. Very warm welcome to you for this webinar, and also all the delegates. Very warm welcome to you. Today, our chairman is traveling and hence he could not join. I welcome him in absentia, and also before handovering the proceedings to the speaker, I would like to introduce you, whom you all know most of the times, because he is one of the most available and I can say highest number of paper presented by him, because he is expert in so many areas of practice. So CA Dr. Gopal Krishna Raju is a practicing chartered accountant, registered insolvency professional and registered valuer, SFA from Chennai. GKR has been awarded honorary doctorate in governance of GST in government sector by Mother Teresa University, Melbourne, Australia. GKR is the independent director in the Independent Directors Data Bank, and they have qualified with distinction the online proficiency self-assessment test conducted by Indian Institute of Corporate Affairs under the aegis of the Ministry of Corporate Affairs, Government of India. GKR has authored 2 books, Standard Costing and Variance Analysis for Professional Students, First Lessons in Information Technology for CA students, with 2 editions by Snow White Publishers, Mumbai. He is a seasoned speaker on information technology, finance and taxation, and visiting or guest faculty for numerous institutions, corporations and business schools. He is also a member of the Institute of Directors, Bombay Chartered Accountants Society, and Madras Management Association, and life member of the Society of Auditors, the Chartered Accountant Study Circle, and an active Rotarian. A passionate writer on technology and taxation in numerous journals and newspapers, a columnist in Tamil Daily, the Hindu Tamil, and weekly Tamil magazines, Nanayam Vikatan and Pudhiya Thalamuri Kalvi. Regularly appears and interviewed in numerous TV channels, Tamil TV channels and Tamil FM radio, including DD Podigai, Jaya TV, News 18, Tamil Nadu, Kaveri News, FM Rainbow. As a versatile speaker, GKR has addressed more than 500 meetings on GST to various forums, including professional bodies, chambers of commerce, industry and associations, trade associations in both English and Tamil. With this introduction, I hand over the proceedings to the prolific and erudite speaker, Dr. GKR sir. Over to you, sir.
Thank you very much, sir. Thank you very much. Let me share the screen. Yeah. Yes. How do I minimize it? Okay. Yes. Very good evening, friends. At the outset, let me thank the Southern India Regional Council of Institute of Chartered Accountants of India. Special thanks to our chairman in absentia and CA Pannaraj, Secretary of Southern India Regional Council. Thank you very much, sir, for the nice introduction. Friends, we are on a very important day today, February 11th, and from tomorrow there will be a change of guards at the Institute of Chartered Accountants. Today's topic is also of much importance. Valuation under Income Tax Act. I'll be focusing on a particular, there are various areas under the Income Tax Act. Valuation takes special place. But one such place is Section 56. And I'll take you very slowly, and I wish to present before you not only the section and the rules, but also various practical aspects. So let me start one by one. I wish to start with this very simple paragraph. I'll make the agenda very clear. There are two sections I'll be dealing with in detail. One is section 56(2)(7)(b). Another is section 56(2)(10). These are the two sections where I'll pay my kind attention for this evening. Now, what is this? Valuation of shares, especially for unquoted or unlisted companies. Valuation of shares of, we can even call it as a private limited companies, or from the income tax perspective, we can call it as a company in which public are not substantially interested. Good. Now, let me take you one by one. Let me unravel this particular section. And I want to make one observation to all of you here. These past experiences from the various news items, I am sure you will remember. Number one, there has been instances where companies have been issuing shares. I repeat, companies have been issuing shares beyond the face value. Now, what is the face value? 10 rupees is face value. 100 rupees is face value. Now, issue shares at face value, very good. Now, issue shares beyond face value, we know the accounting entry. That means if it is for 100 rupees, a 10 rupee share is issued for 100, 90 is share premium. This is accounting. And your accounting standard will prescribe how it has to be measured and how it has to be disclosed. But income tax department is very clear. Okay, as a company, you bring money, you record it as a premium. But tell me very clearly, what is the worth of it? Is actually a paper. And nowadays, even it is not paper, for your information, guys. So let me, I'm sure I'm not able to. Why I'm not able to? Yes, sorry. Yes, it is only a paper. Now,
sir, you stop the screen sharing. Stop.
No. Screen share. I've closed screen share.
Okay.
I will share a little bit.
Thank you. Thanks.
The department is very clear. Okay, you have issued a shares at premium. Let me ask you one question. What is the worth of that particular share? When a new company is issuing shares, I repeat, when a new company is issuing shares, you mean to say the company will be worth beyond the face value? Okay, you have future economic benefits, so you issue at premium. Then what is the worth of that share? So that worth of the share, that worth is called as the value. And today, the income tax department, I will say they have matured one step ahead. One step. I will not say we have seen the full Chandramukhi. Okay, the full blown Chandramukhi we have not seen. We are only witnessing step one or stage one of Chandramukhi. There are still more steps are there, but it's a good initiative by the income tax department that they have introduced 7A, 56 to 7A and 56 to 10. Now, what is these two sections? In short, I will say these two sections are to curb or to stop the menace of money laundering. What is money laundering? I have some money with me. I have 10 crores. How that money I have earned, God only will know. And I want to launder that money. So I want to bring that money into the system. So a 10 lakh share capital will be allotted at 100 times. So 10 times is 1 crore, 100 times is 10 crore. So it is only 10 lakh shares. So I will bring 10 crores, but I will take 10 lakh shares. The remaining 9 crore and 90 lakhs will be share premium. Wow. So one entry, money goes inside. Now, this is where maybe the Prevention of Money Laundering Act, the question can be asked from where you got the money, this is proceeds of crime, all this. So that is a different law where criminal consequences will be there. But under Income Tax Act, it is a civil law. Okay, what is the worth of this company? What is the worth of the share? Why you are allotting at a higher price? So that higher price, that difference will be treated as income. So income in whose hands? Who is issuing the shares? Actually, this particular terminology I will be discussing in detail. Why? Because section 56 to 7A, they use a word called receive in any previous. This has created chacha, and there are notifications given, circulars given by the CBDT. No, that word receive means only the transfer of shares, not new shares. So such kind of what do you call it, as a confusion was brought, and then it was withdrawn, and later it was further clarified. So it now means whether you are issuing for fresh issue or whether you are transferring shares, then 56 to 7A, 7B, sorry, very clearly mentions how you have to go ahead. Now, let me go one by one. Yes. So now, friends, let me be very clear here. For issuance of valuation report under Companies Act, I'll first make this very clear because I have to take you inside the Income Tax Act. Okay, so I'll fix certain aspects, then I'll go inside. A valuer means IBVA registered valuer, and he can use any method, whether it is discounted cash flow method or even that is called discounted cash flow method will come under income method, or under market approach, or under cost approach. Okay, but the Income Tax Act doesn't give you that flexibility. Okay, so that is why I'm coming. The valuer for undertaking valuation, issuing valuation report. Okay, this 11UA I'll be taking you through. Now I want to make one observation to all of you here. 11U is one section which gives definitions like balance sheet and valuation date. 11UA is a section which determines fair market value, and under 11UA you have 1C and 1C as well as 2. 11 UA 1C as well as 2. So 11 UA 2, 11 UA 1C. These are the two sections where it is applicable for valuation of shares and securities. Of course, you have 11 UA 1A for valuation of jewelry, 11 UA 1B it is for valuation of archaeological collections, drawings, paintings, sculptures, etc. Okay, good. Now let me take you to the next point here. So the fair value determined under Companies Act are totally different from what is fair market value under Income Tax Act. And I'll also come back to you with one more case law, some at least 2-3 case laws I want to present before you. There is one such very important decision I'll be sharing with you, that market value and fair market value both are not same. There is one such decision, which is DCIT Mumbai versus Ozone Land Agro Private Limited. I'll come to that. I'll give you the background. Okay. So one more thing which I want to make it here: the fair value under Companies Act and fair market value under Income Tax Act both are not same, because you'll be quite surprised. 11 UA 1C and 11 UA 2, they give some prescription, and the prescription is what is the fair market value under Income Tax Act? That is a question. Okay, that is, I will call it as a Kichidi method. Okay, one is that net asset value. They actually recommend two methods. One is a net asset value, another is discounted cash flow method. Net asset value is actually a Kichidi. I'll explain to you what it is. Okay, so this is your 56 to 10C. I'll come to this and also 50CA a little later. I'll come. Now, this is the valuation date. I want to bring it to your kind attention. This Income Tax Rule 11 UA. They prescribe only two methods. I will once again reiterate two rules. One is Rule 11U and Rule 11UA. Rule 11U is only definition. I will be referring to definition every now and then, especially one important definition I'll refer, which is called as the balance sheet. I'll come to this, because when you want to go by the net asset value on what date? On a balance sheet date. That is why I want to make one observation very clear here, that when you are going by a net asset method, NAV method, the rule doesn't prescribe who has to do valuation, because since you are going to depend upon the balance sheet, and balance sheet means they are very clearly, they have defined balance sheet, which has been prepared by the auditor of the company. So therefore, chartered accountant by default is forming part of the valuation. But only for the DFC method, discounted free cash flow method, I have to give you the fundamental difference between 11 UA CB and 11 UA CC. There are two subsections. Okay, I'll just explain to you these differences. Please wait for some time. Let me take you one by one. Okay, now let me tell you what is this net asset value method. NAV is simply the price per share of I will call it as price per share of the equity. Okay, and as per Rule 11 UA, there is no specific requirement which person will do the valuation, because they have not mentioned the name of the person who will calculate this. But I want to make a point here. They use a word called the book value of the assets, the book value of the liability. So what do you mean by book value of the assets and book value of the liability? You have to go to balance sheet and take the assets and liability value. But except a certain figure, you cannot take a book value. That certain figure is the immovable property. Immovable property, if it is there in the balance sheet, you cannot take the book value. You have to only take the stamp duty value. So that is why I used the word called Kichidi. So this net asset value, there is no term called net asset. Why the word net asset I am mentioning here? Because the formula they have given. They have given a formula: A plus B plus C plus D minus L. L means liability, A plus B plus C plus D. A means asset, and the D means the immovable property, and C means any other shares invested in any other company, and B means jewelry. So these are all assets. So technically you have to add the assets and subtract the liability. That is why it is called the net asset value. Okay, good. Now what is the discounted cash flow method? Now here I have to mention one particular point, that in rule number 11 UA 1C subclass C. I want to make this point very clear here. Rule 11 UA subsection 1 subclass C, and under that C. That is one particular section. Another is rule 11 UA 2 subclass B. So 11 UA 1 CC, rule 11 UA 2B. These are the two places where the term merchant banker has been used. I want to mention merchant banker has been used. So 11 UA 1 CC, 11 UA 2B, in both places merchant banker has been used. Originally before 2018, in both the places merchant banker or an accountant, both were used. Now in 11 UA 1 CC, merchant banker or an accountant is there, but in 11 UA 2B, only the word merchant banker is there. So this is one observation I want to make before I take you into the main part. Okay, so the notification number 23/2018 dated 24th May 2018. Only in 11 UA 2B the word accountant has been removed. Okay, good. So now I will give you a summary of the discussions what I have done now. Then I'll go into the section and the rule. Point number 1. In case the fair market value is based on discounted cash flow method, okay, under income tax act only merchant banker can do the valuation. Okay, good. Now as far as 11 UA 1 CC, they have not used the word called discounted cash flow. They only use the word called fair market value, and you can obtain the report from merchant banker or an accountant. They have not mentioned which method. So the moment the word discounted cash flow is there, that is only in 11 UA 2B. Good. Now I want to give the analogy here with respect to Companies Act also, because this is one place where you will have a dichotomy. So here registered valuer can do, there a merchant banker can do. So whenever people prefer to go for both, they will prefer a merchant banker who is also a registered valuer. Okay, the merchant banker who is also a registered valuer. Then in one valuation both are satisfied. Else you have to get two valuation, and maybe both since it is taken on one particular date, both should be very close. Good. Then in case the fair market value is based on other than discounted cash flow method, income tax act, any CA can do valuation. Now why the word any CA? I want to make one observation that since the balance sheet figures you are going to take, okay, you can even go to other than a statutory auditor, a chartered accountant who is not a statutory auditor, and you can get the fair market value from that chartered accountant who is not a statutory auditor, but that chartered accountant will do the net asset value. Actually the word net asset is not given. I am coining it as net asset because the formula is only ABCD minus L. What is ABCD minus L? Asset minus liabilities. So net asset. Okay. So any CA can do valuation. Why? He is going to take the numbers only from these places, add A plus B plus C minus L, A plus B plus C plus D minus L. Good. It is a very simple formula. But now I am going into the, these are all what I have given so far is the outline. Okay, now I'm going into the subject. Okay, Good. So let me now go to the first foremost point, guys. Okay. The first foremost point which I want to discuss with all of you is what is called fair market value. Wow. Because this is one definition I want to discuss in detail so that I will take you into the subject directly. Now I want to discuss two important sections. One is 222 capital B. Another is section 56(2)(7) explanation. In explanation, they have given various definitions. Like it starts from A, B, C, D, E, and F. Okay. So what are those definitions? Assessable, fair market value, jewelry, property, relative, stamp duty value. Now, I want to bring your kind attention to the explanation 2, which says fair market value. Now, 222B fair market value, I am not going to take, because in Income Tax Act itself, you have a double action of fair market value. Okay, so one fair market value is in relation to a capital asset. Please look at this wording. Meaning, this is a definition which is applicable for capital gains purpose. So the price of the capital market or capital asset would ordinarily fetch in. So I'm not going to take this definition for the current discussion of 56(2)(7)B or for 56(2)(10). Now, for section 56(2), there is a definition called fair market value. Now here, this definition is in relation to a capital asset. This definition is fair market value of a property other than an immovable property. Now you need to appreciate one thing. Now immovable property, why they have not used this definition for fair market value? Because they have given the stamp duty value. Now in the same explanation, this is A, B, you have F definition, which is the 6th definition, which is the stamp duty value. Here they say stamp duty value is the value adopted in respect of an immovable property. So for an immovable property, it is not fair market value, it is stamp duty value. And for your information, even in the rule number 11U, even rule number 11U, when they speak about balance sheet, and in rule number 11UA, when they refer the balance sheet is only referred for assets. Okay, assets other than jewelry and immovable property, because jewelry there is a different way of calculation of fair market value. What is the method? The jewelry, you have to get the open market. There is another word called open market price, OMP. So please understand how many avatars it takes. So first avatar, fair market value avatar. This is the Judua Bai of fair market value, is that fair market value in respect to a property. Now you need to understand one very interesting aspect. The word property is also defined. Property means immovable property, shares, securities, jewelry, etc. So many other things. But when they speak about fair market value, they say fair market value of a property other than immovable property. Now for immovable property, what is the fair market value? That is stamp duty value. And it is confirmed even in 56(2)(7) explanation, last explanation, and also in the rule number 11UA, when they are doing the calculation of the fair market value of the shares, there they very clearly say book value of the asset only you should take, but you should not take the book value of asset excluding jewelry. I repeat the word, excluding jewelry, excluding the immovable property. So they exclude immovable property. Why? Because immovable property you have to use stamp duty value. There they have mentioned it very clearly. The value adopted by any authority for the purpose of stamp duty. Okay, very good. So Fair market value means the value determined in accordance with the method as may be prescribed. Wow. Okay. Wow. So point to be very clearly noted. So as may be prescribed. Prescribed means I will go for the rules. Okay. So that is why I have to jump to the rule 11U and 11UA. Good. The prescribed rule. Now I want to make one more observation, that this section 56.2.7 as well as section 56.2.7A is not applicable after 1st of April 2017. But that is why they have brought the 56.2.10. 56.2.10 only speaks about any sum of money exceeding 50,000 will be treated as income from other sources. Any sum of money you receive above 50,000 is a gift. Okay, so I receive a gift from any person, okay, which is 1,40,000. Entire 1,40,000 is taxable, but there is only exception if I am receiving from a relative or an occasion of a marriage or will inheritance, okay, on contemplation of death. So they have given exceptions. How many exceptions? There are 11 exceptions they have given. So this is one. Any immovable property without consideration. Any property other than immovable property. So that any property other than immovable property is where your shares may come. Okay. Now that is with respect to any person. 56.2.10 is for any person. 56.2.7b, they made it very clear that where a company receives for issue of shares, they have made it very clear, where receives from any person any consideration for issue of shares. So for issue of shares, it is 7b very clearly. Good. Now I am taking you into the main point. So 256.2.7b, I am now taking you into rule number 11U, the subclause B. Actually, this 11U subclause B is balance sheet. The definition of balance sheet. The B is actually balance sheet. 11U subclause J is actually valuation date. And 11UA1C and 11UA2. So this is what I was referring to. 11UA1C and 11UA2 I will be discussing in greater detail. Okay. This 11UA2 is a notwithstanding provision. Since a notwithstanding provision is there, so that means notwithstanding anything mentioned in the above rules, you can follow 11UA2. So please wait. Now this is one place where you have to apply your mind, and I will also take you to some of the case laws. Okay, sir, which rule I have to apply? Why I have to apply this particular rule? All this will emanate. Okay, so let me take you one by one slowly. Good. So these are all the old sections which I have given the date. This is not applicable now. So I'll only be discussing 7b and 56.2.10 with respect to any person. Okay, where any person receives any property other than immovable property. So these are the two sections I'll be discussing. Good. So now let me take you to the important definition called balance sheet and valuation date. So 11UJ, rule number 11UJ. This is a very important rule. And what is 11U for your information? 11U rule is definition rule. And what is 11UA? 11UA is determination of fair market value. So 11U is definition, 11UA is determination of fair market value. So 11U, I will only take two definitions. What is valuation date and what is balance sheet? Because this word balance sheet is very, very important. Many people, they have this doubt. See, today's date is what? Today's date is 11th of February 2022. Now a client is asking a particular calculation. Sir, this is a private limited company. I am getting investors. So I have to issue further issue of share capital. So please give me a valuation of this shares. So, okay. So valuation date is what? He says, sir, today's date itself you take it. Give me in 1 day time or 2 day time. So, or 15th February you are taking or 1st February you are taking as the valuation date. So what is valuation date? property or consideration received by the assessee. Received by the assessee is called the valuation date. So you decide, maybe you have not received it, but you are due to receive. So property or consideration as the case may be received. So as far as of the income tax is concerned, that date will be treated for your as your consideration received date. You cannot claim that no, I have received the consideration later only. So valuation date is 1st of February, but I received the consideration on 10th of April or 15th of April. So that is the valuation date is very crucial. Okay. Valuation date means the date on which property or consideration received by the assessee. Matter over. Okay, because on the date, whatever is the value only, you are going to pay. So the taxability arises. It accrues. The ability to tax, the chargeability to tax arises on this particular date. So this is one point you need to note. That is why this definition is very important. Okay. The actual transactions, payments, transfer from one bank account to another bank account will take later. But for the chargeability purpose, valuation date is the critical. Good. Now, I am also taking you to a balance sheet. Now, why this definition is very important? 11UB. B means balance sheet. Okay. Now, this particular definition is important for one reason. Now, okay, valuation date is done. Now, I'll give an example. So, I have to now take you to the section called 56 no 7 56 to 7. I'll take you to that particular section, read that section, and then I'll come back to this. Okay. This is most important. Okay. 56 to 7b. So that I'll now go to balance sheet. Okay. Where a company, so please understand this section now. Where a company, not being a company in which public are substantially interested. So not being a company in which public are substantially interested means, example, private limited company. And it can even be a public limited company where the stakes of the what do you call it as the government and the public sectors have been diluted. Okay, so that also may come under a company in which public are not substantially interested. Okay, so that is why it is not only private limited company. So where a company receives, actually this term is very sensitive word. Why this term is very sensitive? Because you have a notification also. I'll just share with you one very interesting notification. You will be actually surprised to see this particular notification. This is that notification. This is that particular circular, guys. This is circular number 10/2018, dated 31/12/2008. Actually, it was withdrawn later. Okay, but anyhow, I want to just share with you this particular point. Now, what is this particular circular? This particular circular says no. This section receives doesn't mean the fresh issue of share capital. Nowhere fresh issue of share capital has been mentioned. It is only receives in any previous year from any person being a resident any consideration for issue of shares that exceeds the face value. So now that has been now nullified. Now today this is applicable even for fresh issue of shares also. But if you ask me a question whether it is applicable for buyback of shares, whether it is applicable for bonus shares, whether it is applicable for CCPS, I'll come to all this one by one. Okay, let me first give a clarity on this. I'm going to answer many questions. Okay, so let me first finish this. Next another 20 minutes to 30 minutes, I'll complete all this stuff. Okay, then I'll come to all those the various masalas. Okay. Now, I receive any consideration for issue of share that exceed the face value of shares. Now, I am a company, private limited company. I am issuing a share. How many shares? 10 rupee share I am issuing exceeding the face value. Now, if it exceeds the face value, so I am issuing 10 rupee share as 90 rupees. So what is 80 rupees? 80 rupees is premium. The aggregate consideration received for such a share exceeds the fair market value. That will be treated as that will be treated as. Now I have to make this particular point very clear. They have used the word called deemed to be the income of that particular company. This is given in the proviso, deemed to be the income of that particular company. So if the fair value, now I'll give you example 1, 2, 3 numbers I will give. 10 rupees is your face value, 90 rupees is your issue price, and your fair value, fair market value. They never use a word called fair value. Income Tax Act always use a word called fair market value only. And Income Tax Act doesn't use a word called market value. Always fair market value. And you need to understand one more thing, that even the Central Goods and Service Tax Act, CGST Act and Income Tax Act never use a term called market value or fair value. They only use a word called fair market value. Okay, both. Okay, this is actually OECD. Okay, Organization for Economic Cooperation and Development. All the countries, okay, in the tax regime, they'll only use the terminology called FMV, fair market value. And fair value is an accounting terminology, so don't confuse that with this. Now here the definition, we'll go into it, and never don't merge or mix the definition of ICAI valuation standards. ICAI valuation standards define fair value, fair market value, market value. International valuation standards, they also define fair value, fair market value, and fair what do you call this, market value and fair market value. So those definitions are quite wide. Income tax definition is quite restrictive. That is why even in Income Tax Act, the fair market value takes 2 avatars. One is fair market value in relation to a capital asset, fair market value for a property, fair market value in relation to a property. Okay, in relation to a property, again they say, if it is in relation to a property other than immovable property, you have to go for the rule. If it is for immovable property, it is stamp duty value. Again, if that includes jewelry, no, jewelry you have to go only by the open market price. So other than jewelry, other than immovable property. So immovable property, you have a method for fair market value. Jewelry, you have a method for fair market value. For other assets and liabilities, you have a fair market value. So all are fair market value. So whatever they prescribe is fair market value. So that is why I have given a terminology called Kichidi. So it is net asset. So you just take the method, whatever they have prescribed, take that number, so total it, subtract the liability. Simple. So that is why it is always better. Don't go to the statutory auditor. Statutory auditor has already given the balance sheet. So now, as I said, now we have got this. Now please come to this. This is an exception. Now these two, I want to mention this particular exception. Here I have put it very clearly. Now please look at this. This I am explaining here. Okay, in the case where the company has issued share at a premium during a year and at a value greater than the fair value. So 10 rupees is your face value, fair value is 50 rupees, but you have issued at 80. So now what is the difference between your issue price and fair value, not face value, issue price and fair value. So 50 rupees, 80 rupees, so 30 rupees. So the difference between the issue price and fair value is tax in the hands of the company, because who is recipient? Receiver is the company. So the company gives the paper and receives 30 rupees more than the fair value. Now you need to appreciate one thing here. The department has very interesting views here. So fair value means how it should be. Okay. Now I'm going into the rule, because once you go into the rule gives certain arithmetic, certain prescription. Can the income tax officer choose? Because some options are given. So can the assessing officer say, no, assessee, you are not supposed to take that option, you have to only do in this method? Can the assessing officer say like that? So please wait, I'll go into it. The tax auditor of the company has to report an event, because why this is so important, it will be reflected even by the tax auditor in a specific clause in the tax audit report. So he has to give the breakup as per 11 UA. Now what is this breakup? You need to understand what is this breakup. What the breakup is, that ABCD minus L. Okay, that A, B, C, D minus L. What is this A, B, C, D minus L? This actually A is your book value of all assets. Book value of all assets minus BCD. What is BCD? B is your jewelry value. C is your if you have any assets like shares, you have to take the fair market value of the share as in the manner provided in this rule. So again you have to come back. So that means for that share again you have to go to the balance sheet. So please understand. So A, B, C, D minus L. A is the book value of the assets minus three things. What is the three? Three is number one, jewelry. Number two, shares. These are all will be assets in your balance sheet. Good thing is if you don't have the jewelry, shares, and securities and immovable property, if you don't have these three in your balance sheet, very simple, A minus L. What is A minus L? Asset minus liability. Matter over. Take the balance sheet. Now, when you take the balance sheet, okay, so I'll come to this. This section is applicable only to investee company, but it is not applicable to VC. If it is a venture capital undertaking and a startup company, so these two is not applicable. So that is what I have referred in that particular this section. Not applicable. Provided. Okay. Now come to this provided further. Where this provision of this clause have not been applied to a company on account of fulfillment of conditions specified in the notification issued under class 2 of the first proviso, that is share, that is startup company. Okay, and such company fails to comply with any of those conditions. Now what is those conditions? Startup companies, startup company means their turnover should not exceed 100 crores, number one. Number two, they should be an eligible business. What is eligible business? They should have got the certificate from the Ministry of Industries. Okay, from the Ministry of Industries, they should have got the certificate with respect to the startup from the respective hub. Okay, so the interministerial certification they should have got it with respect to startup. So that is the condition. Now, if they fail to, no, they only say, no, I am a startup, new company, I formed it, so therefore 10 rupees I will issue at 120 rupees. So they have given exemption. So just because they have given exemption in proviso, you cannot say that 120 rupees I have issued, 110 rupees my face value, entire 110 I'll treat it as premium. Nothing. I will not go for fair value at all. So they have mentioned that you have to be very careful. So what is the point here? The point here is you must ensure that if the amount is received is exceeding the face value, it should not exceed the it should not exceed the fair value. If it exceeds the face value, it should not exceed the fair value. Good. Now what is fair value? Come to this. Now I am entering into 11 UA for the purpose of this class. Remember, very important, guys. For the purpose of this class. Now what is the class here? 7B. When they say class, it means 7B. Okay, so 56 to 7B. The fair market value, because the word fair market value is mentioned here. What is fair market value? The fair market value of the share shall be 1. What is it? As may be determined in accordance with such method as may be prescribed. So what is prescribed? 11 UA. Okay, so 11 UA as may be prescribed. Good. Now R as may be substantiated by the company to the satisfaction of the officer based on the value on the date of issue of shares of his assets, including intangible assets being goodwill, know-how, patent, copyright, trademark. I'll explain this, whichever is there. Now, first point, what is fair market value shall be determined? A1, A2. Now remember, guys, as may be substantiated by the company to the satisfaction of the assessing officer based on the value of the date of issue of shares of his assets, including intangible being goodwill, know-how, patent, trademark, other business or commercial rights of similar nature. Now, this is where you need to understand what method I will follow. Okay, as may be substantiated means what? Okay, now I will take you to some of the interesting case laws here. This particular point I will take you to some of the important case laws. A1, I will take you to the rule. as may be prescribed. Now, what is this prescribed? Prescribed is 11UA2. Okay, this is 11UA2, subclass 2. Actually, this 11UA has various subclasses. Now, what are the various subclasses it has? First, it has 11UA subclass 1. Then it has 11UA subclass 2. Good. This 11UA subclass 1 has ABC. Okay, they have ABC has 3 subclasses under 11UA1, and 11UA2 has 2 subclasses. Okay, it has 2 subclasses. Good. My goodness. So now let me first take you to this. As may be determined in accordance with such method as may be prescribed. So when then they say prescribed, I will take you to 11UA2. In 11UA2, they have given 2 methods. What does they say? Fair market value of unquoted equity shares using the ABCD minus L. So A minus L. Actually, this ABCD minus L is given in the subclass 1. In subclass 2, they only mentioned as A minus L. Now, what is this A minus L? Now, let me take you to 11UA2. This is your 11UA2. Okay. This 11UA1C I'll come to a little later, but I'll come to 11UA2 because 11UA2 is what is prescribed in this A1, as may be determined according to such method as may be prescribed. Now come to this. What is it mentioned? Notwithstanding anything in subclass B of C of subrule 1. So this I will be discussing after this. The fair market value of the unquoted equity shares for 5627B. Okay, with respect to explanation A1. This is explanation A1. This is your explanation A1. With respect to A1, okay, with respect to A1, rule number 11UA2 is applicable. Okay, on the valuation date of such unquoted equity shares as determined in the following manner. So you need to understand one thing, guys. See, in the section itself, they have given an option. What is the option they have given? As may be determined according to such method. When you go to the method rule gives class A or class B the option of the assessee. So therefore, 5627A. Okay, explanation A1. Under explanation A1, you have option A, option B. Wow. Similarly, 5627A, explanation A2. What is explanation A2? Explanation A2 is as may be substantiated by the company. Now, company will substantiate. Company can substantiate by going for any valuation. That is why this is open. They don't mention that who has to do it. Okay, you can go for a chartered accountant, take a valuation. Okay, substantiated by the company. Now, company will have to substantiate to the satisfaction of the assessing officer based on the value on the date of issue of the shares of its assets, including intangibles. So maybe if intangibles are there, you have to do the valuation of intangibles also, and then satisfy. For example, I will give you a classic case. You are having a company where land, building, plant and machinery, intangible assets are there, stock is there, receivables are there, and liabilities is there. Now do the valuation of now if you go by A1, you have class A or B. You are not going by class A1, you are going by class A2. Now in class A2, as may be substantiated, you can, when you say fair market value, you can take all the assets, fair market value as on the date of the issue of shares. You can take the valuation report from the respective valuer, the registered valuer under IBBA registered valuer you can go for a chartered accountant with respect to valuation of receivables, stock, intangible asset valuation, land and building valuation, you can go to land and building valuer, plant and machinery, you can go to plant and machinery valuer. Take all this total minus the liability, you will get the net asset, divide by the number of shares, you will get the share value. Substantiated. Now, how can an assessing officer say no to it? So it cannot be. And I'll take you to some of the interesting case laws where assessing officer has said no to it, and he has gone by the various other methods. Okay, and he has taken the maximum value by which has been he has actually appointed through a valuation officer under 55A, and that value he is taking. Now, can you do so? So all this, let me discuss one by one. Okay. Now, whichever is higher, as may be substantiated. So, as may be determined in accordance such a method as may be prescribed, or as may be substantiated by the company to the satisfaction of the assessing officer, whichever is higher. Now, let me take examples here. So, now let me go into this option A and B. Now, what is option A? What is class A or class B? At the option of the assessee. Now, class A. Class A is very simple. The fair market value unquoted equity shares is A minus L into the PV by divided by PE. Actually, the word PV means the paid up value divided by the total paid up equity. Okay, so this is actually the paid up value by the total paid up equity. Maybe if this is, I'll give you an example. So fair market value of the unquoted equity share. So with respect to, maybe if you have multiple shares, okay, one is 5 rupees, 10 rupees, or different types of shares are there, then the total paid up equity and the numerator will be the paid up value of the equity shares which you are valuing. Okay, so that is a point here. For example, total amount of paid up equity share capital as shown in the balance sheet. So this method is totally as per balance sheet. Okay, please look at what is A. So what is your A minus L? L is your book value of liability. What is the A? Book value of assets in the balance sheet. Now this is where I am coming. This is where I am going to come. Now what is this balance sheet? All of you must understand one thing here. Okay, so it is very simple. So this method is very simple. So then one more method is there. Class B. So A or B at the option of the assessee. The assessee cannot find fault with the what do you call it as the assessing officer cannot find fault with the assessee. No. Why did you go for class A? You should have gone for class B. No. Why did you go for class B? You should have gone for class A. No, he cannot do so. That particular part I will discuss with the case law here. Then I'll go to that. This is the case law. Sinistan Entertainment Private Limited versus ITO. Sinistan. What is the Sinistan? 27th June. The assessee has the option under Rule 11 UA2 to determine the fair market value by either DCF method or the NAV method. The AO has no jurisdiction to tinker with the valuation and to substitute his own value or reject the valuation. Now, what is this DCF method or NAV method? Now, please come to this. This is that case. Now, what is this? This is 1A. Here, 1A says either class A or class B. Now, what is class A? Class A is your NAV because asset minus liability. What is class B? This is class B. Fair market value determined by a merchant banker as per discounted free cash flow. Now, why this 2 star is given? This 2 star was originally by a merchant banker or accountant was there. That is why it is deleted. Now, from when it is deleted? From 2018. I gave you that date. 24th May 2018. That was deleted. Okay. So now you have B here. B says fair market value as per merchant banker. Now A is fair market value. Okay. Class A fair market value. Okay. So this is fair market value A minus L. B is what? Fair market value by merchant banker as per discounted. A or B. Any one you can choose. Now, one you have done it. No, this is wrong because balance sheet you have to take. What is A? A is balance sheet. What is B? So A is net asset method. B is what? Discounted free cash flow method. In discounted free cash flow method, you have to go for the future, what do you call it as future income, and you will have the future economic benefits forecasted. Now, when you forecast it, you'll have a lot of questions will be there, because actually speaking, this fair market value based A method using balance sheet method is the most dependable method, because already audited figure. But this method, you will have a beta, you will have growth rate, so many aspects will be there. How will you take that? Okay. And even when you take this fair market value in balance sheet, so many figures will be there. Whether you have to take it or not, we will discuss. Okay. Like for example, you have a deferred tax asset and deferred tax liability. Will you take that? Now please look at A. A, let me read it completely. Okay, A minus L. Now, if you don't have multiple types of shares, you have a 10 rupee share, 10 rupee paid up. That's all. You don't have a partly paid, fully paid. Fully paid is also there, partly paid is also there. Then only this into paid up value by the total paid up value. So that PV means paid up value of the such equity shares. PE means the total paid up capital shown in the balance sheet. Okay, this is actually divided by, not comma. Okay, good. Now, come to what is book value of the asset? Book value of assets in the balance sheet as reduced by any amount of tax paid as deduction or collection at source or as advance tax. Okay, as reduced by the amount of tax claimed as refund under the Income Tax Act, and any amount shown in the balance sheet as asset, including the unamortized amount of deferred expenditure, which does not represent the value of any asset. Please understand, deferred expenditure unamortized means like for example, you have miscellaneous expenditure to the extent not written off. This is called deferred expenditure. Or prepaid expenses, that is called deferred expenditure to the extent not written off. That alone you cannot take. That is not an asset, which does not represent the value of any asset. Okay, but whether deferred tax asset or a deferred tax liability would you have to take? Actually, you have to take. Okay, so please understand this difference between these two. Second, as reduced by any amount of any tax paid as a deduction, because when you have the TDS advance tax in the balance sheet, will you take that as an asset? No, you are not going to take that as an asset. So you will not take tax, you will not take, then the deferred expenditure you will not take. But will you take the deferred tax asset and deferred tax liability? You have to take deferred tax asset, subtract deferred tax liability. So what is liability? Liability includes deferred tax liability also. Okay, for your information. So now book value of liabilities means what? Book value of liabilities shown in the balance sheet, but not including the following. Okay, because you are going to take the asset minus liability. When you are going to subtract liability, you cannot subtract equity shares, because you are going to only find the value of equity shares. So therefore, you cannot subtract equity shares. Similarly, the amount set apart for payment of dividend. So these 1, 2, 3, 4, 5, 6 all belongs to actually equity. So that is why you are not supposed to subtract it. Maybe one by one, if time permits, I'll try to discuss that. Good. Now come to this discounted free cash flow. Now ARB you can use. I repeat the word, ARB you can use. Now that is what I have discussed in this particular case law. What is this case law? Sinistan. Sinistan, what does it say? The assessee has the option under Rule 11(u)(2) to determine the fair market value either by DCF method or the NAV method. The AO has no jurisdiction to tinker with the valuation and to substitute his own value or to reject the valuation. He cannot do so. Okay, he cannot do that. He has already submitted a valuation. You have to take that. Okay. He also cannot question the commercial wisdom of the assessee and its investors. Now, what is this overvaluation, undervaluation? See, ultimately, tax department is only concerned about whether this transaction is a sham or not. See, a 10 rupee share, okay, a 10 rupee share is invested at 98 rupees. Now, the department always say 98 is too much. It should be only 28. 98 minus 28, 70 rupees I am going to tax. So always the department will be in a notion only to see the fair value to be undervalued. Okay, fair value is always overvalued. Okay, they always will think fair value is overvalued. It should be a lesser value. Since it is overvalued, the difference should be taxed. Okay, actually the fair value is less. That is all. Now the option is given to the assessee to actually choose either A or B. And if you go to the section, there is one more option is given. Okay, to the satisfaction of assessing officer, you neither go to NAV method nor DCF method. You can even go by any other valuation method to the satisfaction of the assessing officer. Maybe you can go by engaging respective valuer for each of your category of assets, subtract the liabilities from your balance sheet, and then show, which is almost because you are taking the market value, so that scope is also given. It is not that the what do you call it, as the section is very rigid. No, only option A or B only you should take, because section is very clear. Please look at section. There is one more word. This is that. What is that word? As may be substantiated, as may be determined. Please look at this difference between determined and substantiated. Determined in accordance with the rule. So only as per the prescription of the rule you should determine as per the formula. Now, if it is B part, what is B part? B part is actually our merchant banker. So merchant banker, he will determine, because DCF method he will determine. And if it is book value, you have to determine by the formula, determined in accordance with that method, or as may be substantiated by the company. How do you substantiate? You have to get reports, third-party reports, to the satisfaction of the assessing officer. Now, coming to an important question, balance sheet. Because I'm sure all of you will have question in this word. What is this balance sheet? This word balance sheet, book value of the assets in the balance sheet. Now, you are going to do valuation as on 11th of February, but balance sheet is not there as on 11th February. You have only as on 31st of March 2021. You don't have as on 11th February 2022. Then what to do? Go back to rule number 11U, 11UB, 11U subclass B. What is 11U subclass B? This is your 11U subclass B. So for the purpose of rule 11UA2, just now we were discussing 11UA2, the balance sheet of such company as drawn up to the valuation date, which has been audited by the auditor. My God, this is where the challenge is. So Gopal, Krishna, Raju is going to do the valuation of a company as on 11th February 2022. So I will say, please give me the audited balance sheet as on the 11th February 2022. Now, is it possible, first of all? Okay. So that is why this particular provision is given. Please understand. This particular provision is given for one reason, that you can better have 31st March itself as your valuation date. If 31st March itself is your valuation date, you can take that as drawn up on the valuation date. So this is one method, or this is one opportunity. Actually, maybe if it is a startup company, it is a new company. Okay, maybe if it is a very large entity, drawing up audited balance sheet on between two dates will be a challenge. Okay, but if it is a startup entity, maybe between two balance sheet date, you can bring a audited balance sheet also. So that is why this option is given. Okay, and where the balance sheet on the valuation date is not drawn up, we have not drawn up the balance sheet on the valuation date. So, and that means it is not audited. Okay, so then what to do? The balance sheet drawn up as on a date immediately preceding the valuation date. So immediately preceding the valuation date, 11th of February 2022, which is your immediately preceding, drawn up as on a date immediately preceding the valuation date, which has been approved and adopted in the annual general meeting. So please go to the latest year end. Latest year end is 31st March 2021. Take it sufficient. Now you may have a doubt, sir, that is as on 31st March. Now here rule itself says that. Rule itself says. Okay, so therefore you need not worry about it. Only thing is they use a word called immediately preceding. This word immediately preceding means you should not come today and say, sir, 31st March 2021 still not finalized. I have 30th March 2020. Shall I take it? Is it immediately preceding? it is not immediately preceding. Okay, so that is why so drawn up as on a date immediately preceding the valuation date, which has been approved and adopted in the AGM, which is approved and adopted in the AGM for your kind information, the latest year-ended balance sheet. So that is why this definition is very, very sacrosanct. Now, in any other case, that is, I'll go to rule number 11 UA 1CB as well as 1CC. This is in relation to an Indian company, the balance sheet of such a company as drawn upon the valuation date which has been audited. In relation to a company, the balance sheet of a company drawn upon the valuation date which has been audited by the auditor of the company, appointed under laws in force of the country, because it is not an Indian company in which the company is registered. So the 11 UA 1CB has a lacuna. Okay, 11 UA 1CB has a lacuna. Now what is this 11 UA 1CB and CC? I have to take you to that section. Please take you, I'll take you to that particular section. Please come to this. This is your 11 UA 1CB. Now please look at this. The fair value of the unquoted equity shares shall be the value on the valuation date of such unquoted equity shares as determined ABCD minus L. Now here when they say ABCD minus L, they say balance sheet. Now balance sheet date means the balance sheet as defined under the second part of the definition. What is the second part of the definition? The second part of the definition says drawn upon the valuation date, which has been audited by the auditor of the company appointed under laws. This is having a challenge. So that is why rule number 11 UA 1CB has now been, I will not say replaced. It starts with 11 UA subclass 2. What is 11 UA subclass 2? You know how it starts with? Please look at the word how it starts with. It starts with okay, 11 UA subclass 2. 2. Notwithstanding anything contained in class B of C of subrule 1. What is the meaning? In 11 UA subclass 1, you say as on the date of the valuation date, you must have an audited balance sheet. That is what our balance sheet says, which will be a challenge unless and otherwise you will be forced to actually have year end as your valuation date, or you have to necessarily go for assignment. So valuation is one assignment and doing an audit of that particular balance sheet is another assignment. So you do that. So to give a comfort only, that notwithstanding has been brought. This notwithstanding has been brought only because of the difficulty that has been brought by the previous. So that doesn't mean that, sir, why should I go for rule number 11 UA2? No, you can go by rule number 11 UA 1CB also. You can go by this rule, or you can even go by rule number 1 UA 1CC. What is this 1CC? The fair market value of unquoted shares and securities other than equity shares which are not listed shall be estimated to be the price it would fetch in if sold in the open market on the valuation date, and the assessee may obtain a report from a merchant banker or an accountant in respect of such valuation. But there is one challenge here. This particular rule came when they introduced the section 56 one subclass, I will call it a subclass 7A. When they brought subclass 7A, which is only applicable up to 1st of April 2017, this particular rule was there. Even though this particular rule was there, but when they introduced the 56 subsection 2 7B, in the explanation, they mentioned very clearly, prescribed means rule 11 UA2. So therefore, rule number 11 UA 1B and C will not be applicable for 56 to 7B for your kind information. Okay, so very, very important. Okay, please understand that very thin line difference. So therefore, as far as 7B is concerned, only rule number 11 UA2 is applicable. go by either class A or class B. That's it. Now that is with respect to your balance sheet. Now I want to bring to your kind attention some very interesting cases and now practical questions. I am now going to discuss next another 15 minutes. I'll only be practical. I will not discuss any sections. Okay, very only stories, situations. I'm going to only discuss situations, guys. Okay, so fair value, fair market value, all this I have discussed. Now one more case study. This is Sinistan I have discussed. Let me take you to DCIT Mumbai versus Ozone Land Agro Private Limited. Okay. Now, what is this particular decision? The AO observed that 2% transferred their shares to the assessee at rupees 75 rupees 49 paisa per share. Whereas on the same day, all the other shareholders transferred their shareholding to the assessee at rupee 1 per share. Oh, he observed that when the market rate is 75 rupees 59 paisa, okay, the assessee has purchased the share at less than the market price, that is rupee 1, and therefore the transaction attract provisions of 56(2)(7)(a). 7A is the old section because at that point of time, 1st April, that 7A is applicable till 1st of April 2017. 7B is applicable later. 7 and 7A has now been revoked. Instead of 7, you have got 56(2)(10). Instead of 7A, now you have 7B. The only difference between 7A and 7B is 7 was applicable for firm or a company. 7B is applicable only for a company. For a firm, 10 will be applicable. Okay, good. Now, the assessee, however, argued that under 56(2)(7)(a), fair market value as calculated on 11 used to be calculated and not market price. So you are only asking for market price, and fair market of the share were negative actually, and then the section has no applicability in the given case. Okay, so 1 rupee is actually the face value. Okay, so the fair market value is negative. The tribunal on due consideration ruled that the action of ABO was outside the ambit of law. So you cannot bring a new terminology called market value, because as I told you, Income Tax Act only knows only one value. It is called fair market value, but fair market value has so many avatars. There are two avatars: fair market value in respect to a capital asset, fair market, that is for a capital gains purpose. This is fair market value with respect to property under income from other sources. Number one, no? These two types. Second, fair market value of a property again will take multiple avatars. With respect to the assets and liabilities, you will go by book value. Okay, so fair market value will take avatar 1 called book value. Avatar 2 is called the stamp duty value. Stamp duty value, that is for your jewelry, your immovable property. And another value of fair market value is called as your open market price, and that is for your jewelry. Okay, for your jewelry and for your one minute. So you will have that for your jewelry, artistic work, etc. So for that, archaeological collections, drawing, painting, sculptures, for that you will have the open market price. So it takes multiple avatars. So tribunal concluded that on due consideration ruled that the action of ABO was outside the ambit of law, and only fair market value under 11U can be considered and not market price. So this is one another interesting decision. So one, assessee is free to choose the method. Second, there is a difference between fair market value and market value. Third, I'll take you to another interesting situation. Okay, please look at this. This is your 56, whether it is applicable for bonus shares. Okay, now please understand one thing, guys. Issue of shares means there are two parties. So somebody has to give, somebody has to pay. Okay, now here in bonus shares, there are existing shareholders, and the shareholders, they are given bonus shares from where? From only the reserves and surplus. Reserves and surplus belongs to whom? Reserves and surplus belongs to shareholders only. Share capital belongs to shareholders. Reserves and surplus belongs to shareholders. The reserves and surplus is only given as shares. So technically, there is no actually issue. There is no actually price. There is no price. Okay. So there is no maybe they have allotted for 1:1, 1:2. Okay, so all this would have happened. They would have arrived at some numbers, but to whom you are giving? So you are only taking and taking to yourself. Who is yourself? Shareholders only. So therefore, there is no transfer at all. Technically, there is no transfer. So there has been a constant flip-flop by the CBDT on the issue that whether the provisions of the given section would apply on fresh issue of shares. As the ambiguity prevails, the highly celebrated case can be referred. This is your CIT versus Dalmia, which is a Supreme Court decision, which is a 1964 decision, okay, for determining the applicability of section on bonus issue. So the Honorable Supreme Court in this case, while adjudicating on taxability of transfer of shares, held that bonus shares were acquired without payment of price and not without consideration. And here the word consideration is used. 7b. Any consideration for issue of shares. There is no consideration here. So therefore, 56(2) 7a is the old section, 7b is the new section, not applicable as far as bonus share is concerned. Okay. Now I'll take you to one more interesting decision, one more interesting case, that is with respect to this is the summary of if it is above fair value. Okay, so if you are issuing at fair value, fine. If you are issuing above fair value, what will be the tax implication? Summary, I'm just giving a summary. Startup company anyhow exempted, okay, provided you have got the eligibility certificate from the respective interministerial board under the Ministry of Industries, and they are an eligible business. They have got a certificate for interministerial board, and the turnover is below 100 crore, all this stuff. Then they are a startup company, and if they are issuing above fair value, no issues. But if you are issuing above fair value, then shares issued to a resident Indian. Now, shares issued to a non-resident Indian, not because this section is not applicable for the non-resident. Okay, this section is not applicable for non-resident because 7b clearly uses the word called resident. I will show you the 7b. Where is 7b? I'll just show you 7b. This is 52(7b), and this is 52(7b). So here they have used the word resident from any person being a resident. So that is why not applicable. This section is not applicable for non-resident. Okay, for your kind information. So now I'll take you to that particular summary. Shares issued to a resident Indian. Okay, good. So difference between the issue price and fair value is tax in the hands of the company. Okay, thanks to 56(2)(7b). And auditor of the company, that means tax auditor of the company, must report. That point also I mentioned. So under a specific clause under your form 3CD in the tax audit report. Okay, so what is the amount? Because that amount will be included in the income, so tax auditor has to mention. Okay, so what is the fair value? Fair value is either the breakup value as per 11 UA. Here no certificate is required. Why? Because balance sheet, you are only taking the balance sheet value. Now the balance sheet value is asset minus liabilities. Okay, so 11 UA, and balance sheet is already certified. Okay, and either on the valuation date you have a balance sheet report, or the immediate what is the word called, the immediately available, whatever is your the AGM approved accounts. Okay, closest. Okay, so it should not be a very long time. So my suggestion is it should be less than 12 months. Okay, so immediate means less than 12 months. That is what you have to understand. Again, this can also be debated. Okay, no, it is 9 months, it is 11 months. Okay, so that can be debated. So we don't have any decision as of now as far as that particular word is concerned. So breakup value as per 11 UA, DCF based value, and by the merchant banker. If it is DCF based, it is merchant banker, that is 11 UA2. Okay, so this is your summary. Okay, now I will now take you to buyback of shares. The method for valuation of buyback of equity of a private or unlisted company. Okay, so what is the situation? Okay, as per Companies Act, valuation is not required for buyback of shares. However, valuation report can be obtained from a CA registered valuer for justifying the buyback price. Okay, so now this is buyback is actually by the company from the shareholders. Okay, so do you need to actually have a valuation? You can have a value, but that is only for a justification of that price, because the shareholders may demand for what is the price you are offering for. Okay, good. So now whether the 11 UA of the Income Tax Act states value shall be determined by a merchant banker or an accountant. Now who is an accountant here? So can a registered valuer be considered as an accountant? Registered valuer of IBBI, can it be considered as an accountant? Actually no. The accountant here means as per section 288 of the Income Tax Act. Under 288 of the Income Tax Act, a chartered accountant is a accountant. Okay, for your information. And an employee of the company is also an accountant, for your information. I'll just take you to that particular interesting question. Please look at this question here. This is that particular question. So who is the accountant here? So the accountant means chartered accountant. Okay, and who holds a valid certificate but does not include for the purpose of representing the assessee, except but does not include except for representing the assessee. So that means, can we say here the assessee himself, here any other person who is the relative or officer? Can you say officer can be an accountant here? They have made it very clear, but does not include all this except for purpose of representing. So what do you mean by that? So the company can represent itself, the what do you call it, as the relative can represent, the officer can represent, the partners can represent, but can they do the valuation? No, they cannot do the valuation. So here the accountant means only chartered accountant. Okay, good. Now I'll now take you to another interesting question. In case of a private company, for transactions involving issue and transfer of shares, valuation report of a registered valuer is required under Companies Act. But under Income Tax Act, if the valuation is carried out under DCF, the valuation report should be from a merchant banker. So there is a dichotomy. So here you will, for Companies Act, you will receive from a registered valuer. For income tax purpose, you have to receive from a merchant banker. So then what will you do? So this interplay between the acts is not congruent. Okay. Now whether both the valuation should be similar, that is why to avoid confusion, now practically what people are, it is not recommended in section. It is not recommended in section, but what practically people do is, so they will go for merchant banker who is also the registered value. So the person who is signing on behalf of the merchant banker, he will also hold a valid license from the Insolvency Bankruptcy Board of India as a registered valuer, or sometimes the merchant banker itself, because they are a limited company. A limited company, they themselves can get the license from the IBBI as a corporate or as a LLP. They can be a registered valuer. So the dual work is done there. So that is possible. So that is a company normally appoints a person who is both the merchant banker and the registered valuer to avoid this dichotomy. Okay, so that is where, and that is done, one valuation is sufficient. Nevertheless, if two persons are appointed, it should be close. It should be very close. Maybe the deviation should not be material. Okay, deviation should not be material. If deviation is material, maybe one valuation is a superfluous valuation. Okay, so that is the conclusion. Now I want to take another few more minutes and then take questions from all of you. Maybe I want to take questions like deferred tax liability, which I want to bring your kind attention here. Whether deferred tax asset shall be considered as asset under Rule 11 UA, or is it considered as fictitious? Now, one thing we have read in the rule, when that definition we went to it, that what is the balance sheet, what are assets you have to include, what are liabilities you can include. In the assets, they are mentioned very clearly that deferred expenditure you cannot take. Okay, so deferred tax assets are not fictitious assets. Deferred tax assets shall be included. Similarly, deferred tax liability also shall be deducted. Very important. Normally, deferred tax asset may not be there. I repeat, deferred tax asset may not be there, but deferred tax liability will be there. So since deferred tax asset is not there, they leave it. And deferred tax liability also they will leave it so that the valuation will be more. So please be careful here. So deferred tax liability is that you have to subtract it. You cannot say that no, asset is not there, so liability also I leave it. It is not so. So please be careful here. Okay. I'll take to one more question, guys, to all of you. Maybe I want to bring your kind attention here. How will you deal with the growth rates? Okay. Okay. So I just want to take you to this particular part. Okay. Question number. I want to take you to this part is very, very interesting question, guys. How does the formula and the DCO work if the perpetuity growth rate is higher than the discount rate? Now, I want to bring to your kind attention this. I'll take an Excel. Excel, you will understand that arithmetic. I'm sure all of you will appreciate this arithmetic. So you know this. So I'll take this as. Please look at. Okay, so I'll try this 400. Look at this. So all of you know this formula. So D1 divided by KE minus growth rate. So this is your formula. Now there is a presumption that KE is always greater than growth rate. Now come to this particular question. Yeah. What if the perpetuity growth rate is higher than the discount rate? So this is very important. Now I just take you to one interesting D1 KE growth rate. So D1 is maybe you can call this as D6 because you want to, that is your horizon period. So dividend for year 6 or your free cash flow for year 6. This is your free cash flow for year 6. Okay. So that you will divide by KE minus growth rate. Say it is actually 24 crores. KE is actually 12%. Your growth rate is actually say 5%. So what is your terminal value? Terminal value is your free cash flow divided by KE minus growth rate. Now, this is 342 crores for your information. I just want to share with you one interesting stuff here. That if your growth rate is 6%, growth rate is 7%, growth rate is 8%, growth rate is 9%, growth rate is 10. See, as this number, as the gap is reduced, okay, as a gap, this 11, 2,400, where I was actually. So this is 2,400, guys. Okay. Now originally it was 5% and it was 12. It was 342. Oops. Where is 342? Where is 2,400? It's only the gap. Now what will happen if it is negative? This is 12. This is 13. Sorry. This is 12. This is 11. Let us take. Okay. Can it happen? This is coming as negative. Is it possible? Now what to do with such circumstances? Okay. So there is a presumption actually. Growth rate beyond. See, generally growth rate, why we are taking only 5%, 6%, 7%. See, horizon, beyond horizon, you are not able to perceive what will happen. So that is why you only keep a constant growth. And can that constant growth be beyond KE? Okay, so this entire Gordon model has an assumption. That assumption is KE is greater than growth rate. If KE is lesser than growth rate, then valuation will be negative, as you are seeing here. So that is why it is explained here. Please understand this. So very, very important. So it will turn negative. So the expected growth rate should be constrained to be less than that. So if the growth rate of the company is more than the growth rate of the economy for infinite period, business eventually become larger than the economy. So that point is a very interesting point for your information. I want to discuss so many aspects like this, but I wish to share some questions. I want to actually answer some questions. So let me now maybe I will request Selva to come out with the questions and then I'll try to answer those questions so that many other queries I'll try to answer through those.
1 minute, sir. So that's my screen visible, sir?
Absolutely. Okay. There is no option to take the interim financial statements since they are not adopted at AGM ideally. Now, what is this? Is this a question or you are giving a statement? I'm not clear. There's no option to take interim financial statements. Actually, maybe I'll rephrase the question. Interim financial statements, if it is there, well and good. Okay. If it is not there, the 11 U8 subsection 2 very clearly says balance sheet means the definition of balance sheet with respect to 11 U8 you can go to the, what do you call it, as the immediate. You can go to the immediate preceding the valuation date approved. Immediately preceding the valuation date you can go. This immediately preceding the valuation date should be my perception, let us not go beyond 12 months. Okay. If the company is incorporated on 1/5/2021, valuation is to be done on 11/2/2022. Okay. So then you drop a balance sheet as close as possible, maybe on 31/12/2021, and get it certified. So that is the only way. See, this entire principle, this entire section, how it operates. So one is, I will go by either a DCF method. DCF means it is SEBI registered. So that means they are regulated. Now, if it is NAV method, how it is regulated? Through chartered accountants only. So therefore, by and large, you have to involve professionals. If I'm right, this is a startup company. 1/5/2021 means it is a startup company. So drawing a balance sheet and getting audited in the latest, I don't think it will take much time. Okay, so unless and otherwise it's a very large company, in between that audit will take time. No. Okay, so therefore it is a best practice, and the provision believes chartered accountants. So that is why even though the time is actually only from May, this is actually February, that means less than 10 months. So it is ideal, and it is also advisable to have a chartered accountant's balance sheet earliest, maybe by 31/12. Can we use balance sheet dated 31/3/20? I think a lot of questions from balance sheet is there. Can we use balance sheet dated 31/3/2021 for valuation report dated 11/2/22? Yes, I gave the answer. So because that is the word immediately preceding the valuation date. Immediately preceding the valuation date, approved and adopted. Can you ever have approved and adopted in AGM? There cannot be any other AGM. So your question is a valid question, and you can take it. And it is as per 11 the balance sheet, I mean the section B balance sheet, it satisfies your question, you can take. In the formula, present value of such equity shares, can you please explain the meaning of such shares? So I'm not able to understand from which section you have been asking this question. Maybe if you have mentioned the question section, I'll try to explain that answer to it, or we can take this question offline also. Can a private limited company issue equity shares to non-resident for a premium without valuation certificate? I have mentioned it very clearly. Now, since this value, this non-residents, they don't come under 56(2)(7)(a). Non-residents, they have a different FEMA prescription is very stricter, where the valuation has to be done either by a SEBI registered merchant banker or a chartered accountant, and there the fair value, whatever that has been decided, it should be at the fair value. So better not exceed it, better not less than that. It should be at fair value. So FEMA provisions actually better to follow FEMA provisions, and FEMA takes care of it. And 56(2)(7)(a) is not applicable. Coming to your question, can a private limited company issue equity shares to non-resident Indian for a premium without valuation certificate? As far as the section is concerned, 56(2)(7)(a) is concerned, not applicable. But as far as FEMA is concerned, it is applicable and valuation certificate is required. In that ABCD, D stands for, actually that word D is for immovable property. Okay, A is for the book value of assets excluding jewelry, then shares and immovable property. So BCD. What is BCD? B is actually jewelry and C is actually shares and securities. D is actually your immovable property. So in that ABCD, D stands for immovable property. Which type of businesses can adopt DCF method for valuation of issue of shares? Are there any restriction? Technically, no. Now that is why the Income Tax Act doesn't go into the valuation stuff. The point to be understood here is the DCF means only merchant banker. Point number one. Point number two, when merchant banker applies DCF method, DCF means future economic benefit. That means there should be a standing. The company should have a standing, then only there will be a future economic benefit. Even a startup company will have there will be a future economic benefits will be there. So you need to go by the tax circumstances to actually appreciate whether the companies, for example, recently I got the hospitality industry, quite a number of valuations I am actually addressing where the management is very keen. What is the worth of my hotel? What is the worth of this hospitality industry? Now, if it is a normal circumstances, I will go by, because even though they are an established hospitality sector, the normal convention is you go by the projected income, those concepts, then you discounted all this you can do. But today management is not confident that they will have future economic benefits, they will have future income. Their business is bleak. They have 230 rooms, but only 5% or 10% is occupied. So post COVID, what they want to do with that, they don't know, and they are coming for a valuer to assess the valuation. Now you tell me, should I go for a DCF and can I give rosy picture? No, you need to understand business. Now what assumption can I make? No, the post to COVID, everything will be opened up. Hospital industry will be very good, travel industry will be very good. Now the hotels will go up. Now I will go by now this, can I do the assumption? No, management has to be very confident about it. If management itself is not confident, now based on the industry perception also I will go back. So therefore, which type of business can adopt DCF for valuation of issue of shares? So therefore, this is actually a general question. If it is an income tax related question, maybe I want to make it very clear that if it is DCF, it is only the role of the merchant banker. But if it is a general question, the question what I have put, I will go by the facts, circumstances. I can even negate, no, DCF will be the second criteria. I'll only go by the cost approach or maybe by the market approach. What is the similar industry, recent transaction that has happened nearby or similar industry? So I will try to adopt that method, which actually will take some time, and you need to take a lot of data from the market. Whether valuation required for rights issue, please explain under each act. Okay, so actually it's a very interesting question. Yeah, under section 62, under section 62 of the Companies Act, if you are going for further issue of share capital, valuation is must. Okay, valuation is must. So that is with respect to the further issue of share capital under Companies Act. Now when you are giving it to the right issue for the existing shareholders, now whether 56(2)(7)(a) will be attracted? Yes, 56(2)(7)(a) will be attracted for a private limited company. So therefore, under Companies Act, as well as under Income Tax Act, both applicability is there. So under Companies Act, it is section 62. Under Income Tax Act also 56(2)(7)(a) will be applicable. Sorry, 7B will be applicable. Now, whether valuation required, no, sorry, for valuation of fixed assets at stamp duty value, that is immovable property, can we adjust for tax or cost of selling the land or building, like closure of business? Note, land used by business won't have same value to the business as vacant land. Now, I think I have to understand this question. For valuation of fixed assets at stamp duty value, can we adjust for tax or cost of selling the land? Okay. Or building, like closure of business? Agreed. Yes, you have to do it, because the premise, because when you do the valuation, even though you take the stamp duty value, there will be a cost attached to it for transfer, because from whose perspective you will do it. For example, you are doing the valuation from the buyer's perspective. If it is from buyer's perspective, it is not only the stamp duty value, there will be a cost with respect to your 9% plus 2%, 11% stamp duty. I mean, the local taxes will be there. So, and other, what are the other costs? Maybe the transfer cost, legal cost, and maybe the refurbishment cost, all this stuff. No, land used by business won't have the same value to the business as vacant land. I agree. So you need to consider. So that is only a base value. So you have to factor the other costs. These are all real costs which you have to factor it, which will be more than the stamp duty value. In FEMA also, do we have to take audited balance sheet or approved and adopted balance sheet? Will provisional financials will work? Oh, good question. Now there you are going to measure, there is no concept called net asset method there in what do you call it as FEMA. FEMA actually gives it very clear. So you have to do the fair valuation, and based on the international practices, follow the best practices and also the standards adopted. So they leave it to you. You can even go by cost approach. You can even go by, FEMA doesn't restrict you. So no, I will not go by what do you call income approach. I will go by net asset. Agreed. You go by net asset. If you go by net asset, then balance sheet is required, because what is the authenticity for net asset? So balance sheet is your authenticity. Now, will provisional financial? No. That authenticity is the question, because you are a valuer. So you give a valuation. So better to actually go by authenticity. If it is actually a DCF projected basis, you get the financials. Not only financials you get from the management, that financials you have to corroborate it. See, valuation report, there can be two types of value. One is called a calculation valuation report. Another is called as a estimation valuation report. Third is a comprehensive valuation report. So a number given by a management is not it is not that it is complete. It is all future figures, rosy picture. Have you corroborated it? It is not audit. You are not doing audit. You are only corroborating it. What do you mean by corroboration? On what basis he has given that number? Is there any basis? Is there any logic? Or he has just taken the number from clouds? He can say, no, I have done a trend of 8%. Now trend 8% from where he took it? What was the trend for the past years? Historic trend. If historic trend is 10%, he has taken 8%, good. If historic trend is 5%, he has taken 10. Why double he has taken? Is there any reason for doubling the trend? So this is called corroboration. So that means he has some orders, he is having he's already negotiated with the client, and client has already agreed, an agreement has already been signed, only purchase order is pending. So then the 2x can be taken. So that is called corroboration. That means, are you doing an audit? No, you corroborate. You are doing beyond auditing, because you are giving an authenticated number. That number you should be in a position to explain. So that is why that is important. So provisionals, if you are doing it, please do corroboration. Then only it is called as a comprehensive valuation. Otherwise, it is only calculation. In the fifth question, are CAs allowed to give valuation certificate under FEMA? Yeah, I gave this answer. FEMA actually agrees for both chartered accountant as well as a SEBI registered merchant banker. I have already answered this question. Why DCF done by merchant banker is considered better and not by registered valuer? Your opinion on this stand of your opinion on this stand of income tax department. Actually, it is only phase 1. There is we already have 4,000 plus registered valuers under Insolvency Bankruptcy Board of India. Out of that, 1,500 plus are chartered accountants, cost accountants, company secretaries, who are all SFA valuers. And in 2020, there is a valuers bill 2020 that was brought out, and it is still pending. And in that 14 Act was supposed to be amended. 14 Act, where registered valuers will only give the certificate, which includes Income Tax Act, GST Act, FEMA, PFRDA, and PMLA, Prevention of Money Laundering Act, Prohibition of Benami Property Transaction Act. So all this stuff, all these laws, they are going to recognize the registered valuer. There were some legality with respect to questioning the bringing that particular valuers bill. Till before month, we had the IBBI, the chairperson was a different person. From yesterday, new chairperson has been appointed, and we look forward from the new chairperson that this valuer bill, even though it is 2 years old, it has been kept in cold storage. It has gone back to the Ministry of Law, and there are some more legal cases pending in various courts against this particular as the executive decision of bringing a summary as well as a draft valuers bill. If it is quashed, then it will see the daylight at any point of time. So please wait for some time. I was actually expecting an amendment every year with respect to amending the particular provision of rule where the word registered valuer will be brought up, and also chartered accountant will be restored, slash chartered accountant slash registered valuer slash merchant banker. So I was expecting every year. Maybe since it is tangled in between, government is taking steps to actually remove all those things. In the formula under rule 11 UA2 A minus L, what is PV? Okay, that PV is actually your paid up value of equity shares, and PE is your paid up value of equity shares. PV is actually a paid up value of such equity shares. Oh, such shares. Now I'll give you an example. See, you have two types of equity shares. One is a 10 rupee paid up share capital, which is 10,000 into 10 rupees. Another is 3,000 into 5 rupees paid up share capital. Okay, 3,000 into 5, 10,000 into 10. So now 13,000 shares are there. Now you are going to do valuation of which shares. So is it 3,000 shares or 10,000 shares? So no, you want to do for both. Then you have to take in the Indian Accounting Standard 33 earnings per share, they would say VANOS, weighted average number of equity shares. So you have to take that. So yeah, otherwise, no, I only want to find the value for the partly paid up share capital, means the PV will be the partly paid up share capital, PE will be the total. So that proportion only we will take. Else, if there is only one equity share, PV and PE both will be same. Okay, so it is only A minus L. That is why it's called such shares. Explain effects of a startup failed to other to DIPP notification. Govinda, that's all. Govinda. That means they have to other to 5627B. They don't have see, what is 5627B not applicable to startup? Why startup that is not applicable? Please tell me the answer. 10 rupees is the fair value. Sir, 10 rupees is the face value. 70 rupees is the fair value. Now, being a startup, you want that 70 rupee to be 140 rupees. So beyond fair value, you want to bring money. There, 5627A says, no, I will not tax you because you are startup. So I will not tax you. So enjoy. Because you are innovation, you have brought innovation, you are eligible business. But when they fail to other to DIPP notification, BUS means whatever exemption that they have got between 140 rupees and 70 rupees, that will become taxable. So they have to be very careful when they have got the exemption, when they have got the tax exemption under 5627B. They should ensure that they have to follow the norms as per the DIPP notification. Okay. Now we have one more last question. For issue of share valuation report, for issue of share valuation reports required Companies Act, registered valuer, income tax registered valuer, FEMA merchant banker, is it create duplicate? Correct. Is this position will be same in valuers bill, or this anomaly will be rectified? Now, my view is the purpose of valuer bill that has been brought is only to you nullify, to actually bring everything at par. So that means everywhere the word registered valuer only will be there. So whether in Income Tax Act, Goods and Service Tax Act, FEMA, in PMLA, in Foreign Contribution Regulation Act, in your PFRD Act. So in all this, and also Prevention of Benami Property Transaction Act, Black Money Act. So in all this, you will have only the registered valuer. So that will remove all these anomalies. Okay. So thank you very much, friends, for the wonderful opportunity given to me to interact with all of you. And special thanks to Secretary CAS Pannaraj for being very, very patient.
Over to you, sir.
Okay, sir.
Finish the video.
We're done with it. Yes. Thank you very much, sir. Great efforts from you. With just 3 minutes to the closure, but the queries perfectly managed the show, and the number of queries that are raised shows the interest that the members have, and the way you are presenting the things and clarifying the things, they are understanding and they are trying to get the doubts clarified. So thank you very much on behalf of the SIRC for taking this session, and as usual we keep in touch with you for the coming days also. Maybe this may be my last session as secretary, because there is a change of guard on 17th of this month. So as a secretary also, I thank you very much for the whole year's support that you have been doing, and I thank each one of the members for the consistent support that you have been giving by participating in these programs and making use of the efforts of our programs. Thank you all the members on behalf of SIRC. I also thank the chairman in absentia and the back office, Parameswaran sir and the staff. And special thanks to Mr. Selva for making this happen, and also Monica for coordinating the staff and other speakers. Thank you very much. Thank you all. Stay safe, stay healthy. Thank you.